Do you know why 90% of traders lose 90% of their capital within the first 90 days of trading? Because nobody teaches when not to trade. Everybody just come into this market and press the buy and sell button recklessly daily in hope of making some ridiculous profit overnight. More often than not, the result of this is multiple blown accounts, and I'm sure you've actually blown many accounts because of this as well. I personally myself have blown countless accounts just because of this reckless attitude and negligence. If you want to attain consistency, then you must do what 90% of traders are not doing, and this particular video is going to show you how. Do make sure you stick with me until the end of this video, and I'm very sure by the end of this very video you're going to become a professional market analyst that makes decisions logically and trades responsibly. Okay, without much ado, let's quickly dive into this. There are basically two types of trade, and this is actually my own personal postulations, and it is actually true. The fundamental trend and the technical trend. The fundamental trend is the macro market trend determined by fundamental tools, while the technical trend is the current price action trend as seen on the chart. We arrive at this fundamental trend by a detailed statistical analysis of forex fundamentals outside of the chart. In other words, the trend of the forex market can be determined and deciphered by looking at macro fundamentals. And this is devoid of all manner of subjectivity. That is, it is uninfluenced by personal biases and opinions, such that if two different people that have never met themselves one time or the other look at the same statistical data set, they can arrive at the same decision of what the market trend is. And this is how professional traders beat the street money, the dumb money. And we as traders in the know understand that the odds of trading success are tilted in our favor when the technical trend aligns with the macro fundamental trend. And this is what makes for high probability trading conditions. This removes all manner of doubt. We stay on the sidelines when we can't decide what the macro fundamentals are suggesting at any point in time. Okay? Now, market analysis is subdivided into two actually. And again, these are my personal postulations, and they are true, as you're going to see for yourself. The fundamental and technical analysis. And I believe every trader should be both a fundamental trader, in fact, first a fundamental trader and a technical trader. Because it is the juxtaposition of these two that makes for a reliable market analysis for directional bars purposes. Now, on fundamental analysis, there are the concepts of CO2 report reading, interest rate differentials, seasonal influences, and intermarket analysis. Now, you just need two of these fundamental analyses to be in alignment for the determination of the trend. In other words, you can know the trend, the macro trend of the market, without even looking at the chart. And this is the first step. This is the first step in solving directional bias order. This is what we call macro market analysis. Now, for a detailed explanation on this fundamental concept, I mean the concept of CO2 report reading and interest rate differential, check out this particular YouTube channel. There is a playlist on macro market analysis. Of course, there will be a link in the description of this video to that particular series. Again, for the fact, you only need two of these fundamental variables to determine the trend of the market. For a detailed lesson on seasonal influences and intermarket analysis, let's have at least 100 likes on this video, and I'll prepare a lesson on those on this YouTube channel also. And if you're not subscribed to this channel, make sure you are subscribed so that you won't miss those two lessons. Now, for a brief overview of what seasonality looks like, here is the seasonal pattern for crude oil. Now, I use this and CO2 report where there is not the possibility of checking interest rate differentials for the particular asset class I am considering, just like this crude oil futures. Well, someone will say the fundamentals in crude oil should be the regular OPEC meetings news release. To me, it is not. It's just a reactionary state of the OPEC members, and they adjust to the real fundamentals, which is this, the seasonals. So if you look at the seasonals, you will notice that just around August, September, we see a market rally until December. Okay, so the market usually peaks through around July, August. So we make a low, a long-term low around July, around August into September. Then we rally to the upside aggressively. Okay, the seasonality of crude oil futures is suggesting higher prices for crude oil. Okay. Now, here is a quick peek on that. Seasonality is actually a pattern that repeats on a yearly basis, and this is for crude oil futures. Okay, analyzing seasonal trends, of course, allows us to have a better understanding of oil consumption. Crude oil is refined into gasoline and distillate, so the seasonal trends in crude oil inventories are in line with demand for gas and distillate. Okay, so during the first up leg from February to May, inventories increase because refineries are preparing for the summer driving season to come. Okay, so these are the seasonals. This is what happens on crude oil futures based on seasonal patterns. Okay, this is not, of course, a B heat and oil thing. It doesn't stand on its own. We use it in combination with other variables like CO2 report reading. Okay, so this is not a signal. Okay, it's just what you use to derive a trade idea, and it's all actually act as a supporting tool for your other analysis. Okay, so from September to November, inventories build up as refineries shut down for maintenance. Okay, then seasonal peaks usually appear in April, May, and November. Troughs in January and September. The peak and troughs of crude inventories are roughly M-shaped. So from June to August, the first down leg happens. Then the demand for oil surges because people travel a lot in the summer. Refineries pick up pace to produce gas and distillate. Crude oil inventories decrease as a result. So during the winter, demand for heating oil surges, then crude inventories decrease. So what this means is that during this November, we usually see price rally on crude oil. Okay, so that's for seasonal patterns on crude oil. Now on to the CO2 report for crude oil. Here is actually where you want to pay full attention, because we're about to get our hands dirty with the real practicals. So let's dive into it. So on batches.com, we can find the CO2 report for oil futures. So here is a picture from the site for crude oil futures. Again, there is a video on my YouTube channel explaining this in details. As a rule of thumb, if you look at this chart, we focus more on what the commercials are doing on the CO2 report, as we expect price to do just the opposite of what they are doing basically. Of course, there are other ways of looking at it, but this is the cookie cutter approach to it, and it works. That being said, looking at this chart, we can see that the fundamentals are positionally bearish, which suggests what? What do you think this suggests? Pause the video and can you think what it suggests? Yeah, if you say higher prices, then you are correct. Just bear with me, we are still going to go to the website for the numbers. This is how I do it, and this is how you should actually do it. Now, looking at this chart, what can you see? Apart from the fact that the commercials are a net short heavily on this one, you can see that the commercials are positions, open interest is around $246,000, not dollars here, 246,872 shares. Of course, net short, you can see the minus sign there. Okay, and you can see that this has actually dropped right here according to that seasonals. Okay, so the red line is the commercials. Okay, and that is what we actually pay attention to. Okay, so what can you see on this chart apart from what the commercials are suggesting on the chart itself? Based on price action, what can you see? Okay, this is where you actually want to pause the video and see if you can actually decipher this. Pause the video here. Okay, it is evident on this chart that crude oil is running for this buy sell liquidity above price in form of buy stops. Okay, now you can see it evidently here. We have equal highs evidently present here. So crude oil is running for that buy sell liquidity. That is where the drawn liquidity is. So at least we are going to get to $100 per barrel at least. In fact, I believe crude oil is going to run above 120 per barrel, $120 per barrel before the year runs out, if all things are equal. Okay, so without much ado, let's go to backchat.com for a quick practical on how I navigate that website. Okay, here we are on backchat.com, and I'm referencing the legacy CO2 report for energy futures. Okay, so if you come to backchat.com, I'm referencing the legacy report. Okay, here, and I'm considering the energies. Okay, so on crude oil, it is evident that since August of 23, August 23rd of this year, the commercials have been shorting. You see, they have been selling minus 260,256. On August 30, they added more short, and as a rule of thumb, the theory behind this is that in open interest, for sales to actually happen in the marketplace, there must be a corresponding buy. Okay, so if they are selling, that will translate to the market buying. Okay, it's as simple as that. Okay, so they are selling. So the CO2 report is suggesting what? That we should buy, since the commercials are what? Are selling. Look at for how many weeks they have been selling, right? Okay, and according to the seasonals we looked at earlier on, that is also suggesting what? Higher prices on crude oil futures. Okay, so those are two variables coming together in alignment. Okay, and this forms my directional bias. Even without looking at the chart, just by looking at these two variables, I already arrive at a trade idea. Of course, it's still a trade idea, not a trade signal. Okay, I need to validate this idea now on the chart, and I won't force what is actually on the chart on this. I'll wait for the chart to align, and we're still going to go into that in details when we get there. Okay, so this is the narrative, and this gives us directional bias. Notice how I have actually combined the Dow of seasonal tendencies and CO2 report for a fundamental perspective on price. Okay, and this is how I arrive at a trade idea, as I said earlier on. At this stage, is it just a trade idea, not a signal? Each of these variables are not a bit end oil of a thing. They are not the end in themselves. They complement each other. And now let's go to the part where you are really interested in. Okay, folks, welcome back. Now, on technical analysis, it is pertinent to understand that the markets are continually offering buy-sell liquidity and sell-side liquidity from external to internal liquidity and vice versa inside a specific interbank delivery algorithm dealing range, targeting buy stops and sell stops of filling liquidity voids, which determines the draw on liquidity in line with the market structure, and the cycle continues like that. This is not vague. It is very straightforward, rule-based and concise. For the sake of not boring you with so many details, this video will be a series of 3, so do make sure you are subscribed to this channel and return for the remaining series. For this particular video, I will touch on price delivery theory a bit and do an overview of the interbank delivery algorithm dealing range, IPDA Dealing Range, Again, I'm not the author of this concept. Michael J. Alderson, that is innercircletrader.com, is the author. Okay, so you can go directly to his channel. Is the best bet for you to actually learn these things. Okay, so he's the GOAT. I'm giving credit to him. I'm not the author. This is just my own personal interpretations and how I actually use this on the chart week in, week out. Okay, so in the subsequent series, I'll go in depth on this particular dealing range and how I use it, liquidity concept, and market structure. So you must just know that this lesson is not complete without the other series. Okay. So again, to reiterate what I said on our price delivery, on our price delivers, price moves basically from external liquidity to internal liquidity. Okay, so that is the price delivery theory. Okay, it's nothing more than that. So price moves from external to internal liquidity, internal to external liquidity. Just like that. It's as simple and straightforward as that. And you can see here is a virtual representation of that, pictorial representation of that. Okay, so as a rule of thumb, you can just pause the video and screenshot these. Don't take my word for it. Go back to your chart and you will see these things vividly on the chart, week in, week out, monthly, yearly, they play out. So on the buy-sell liquidity aspect, so when price takes out previous year's high, then price will return to a weekly fair value gap. Okay, so it is very important you watch the upcoming series on this particular video. Okay, because when we talk of previous years high, previous quarters high, we are talking of liquidity concepts. Okay, what drives price? And when we talk of fair value gaps, we are still talking of liquidity concept. So it's important you watch those upcoming series. Make sure you are subscribed to this channel and give me a thumbs up if you actually found value in this video, and leave your comment. I want to actually hear what your suggestions are, how this video is actually impacting your trading, and what I can improve on. Okay, so when price runs out previous quarter's high, we are going to return to a weekly, the nearest weekly fair value gap in the particular dealing range that we're high in price. Okay, and when price runs out previous month high on the chart, then the next probable drawn liquidity should be the nearest daily fair value gap in the dealing range that we're high in price. And when price runs out previous week's high, then the next probable draw on liquidity is a 4-hour fair value gap. Okay, and when price runs out the previous day's high or low, then the next probable direction, okay, of course, that is always in line with macro fundamentals, is 1-hour fair value gap. And when price runs out previous section's high, then the next probable drawn liquidity is a 5-minute fair value gap. Okay. Now, I'm going to, there's a video I recorded on August 23rd of this year, 2022, for my folks in-house on price delivery theory. In that particular one video, I spoke about how price delivers, liquidity concept, dealing range, intermarket analysis. I'm going to attach that particular video to this recording. So let's look at it and the result of that. Okay, so another one on market bars or directional bars. So this is EU now. If you look at this particular chart, you see that from this range high here to this range low, okay, so that's our range. That's the range we are considering in price, right? So price came back into premium, right, inside this fair value gap. So price has repriced fair value gap, and something right here, price took out last month's high. That's external rating, right? This push up here, we can see it as a Judah swing to take out line, external rate liquidity. And like I said, price actually moves from external to internal and internal to external, just like that, nothing more than that. Okay, so, and actually we use XMT divergence to actually confirm it sometimes. So this one was making a higher high, but if you look at GU right now, GU is failing to make a higher high, right? So that's XMT divergence. So safety divergence. So this is telling us one thing, that EU is ready to price lower. Okay, and I'm going to show you that. So we also have trendline liquidity here. From external now to internal, where is the liquidity? This fair value gap here. That is the draw on price. So next week now, I'm focusing just on sales, right? It doesn't mean I can buy and still make money, but the more probable direction is to focus more on sales based on the narrative. So this is the narrative now. The narrative is in place. So every week, every day of next week, I'll go in, at a time where I know the algorithm will be priced, right? So, and I will engage, right? So it's as simple as this. So external to internal and internal to external. Then if you look at the 4-hour time frame, you see that we already have a structure shift. Look at it here. We have a mitigation block right here, right? Right? So that's a mitigation block. So price returning back to that mitigation block, that's the mitigation block I draw out. I can sell from that level. Then if you look at the dollar index, okay, checking the dollar index, you will see that we also have a mitigation block right there. Then we also have a fair value gap inside there on a 4-hour time frame, right? Then looking at the daily time frame of also the dollar index took out last month's low. Okay, then it should reprice higher into this fair value gap above price. Okay, so if last month's low was taken out, then the next probable draw on liquidity should be daily fair value gap, daily bullish fair value gap. I'll send you a flashcard, like a flashcard that can guide you in that perspective, kind of, yeah. Okay, folks, so here is the result of what the previous recording I did. Okay, now, some people would just say, I'm cherry picking, right? But this is not cherry picking. Don't take my words for it. Go back to my YouTube channel here. I did a live market outlook. I guess I did it twice or so on this particular YouTube channel. For the record, if you check the dollar card, I predicted that we are going to run higher for some thousands of pips, and it has actually played out. And there are others like that as well. And if you want to watch me call these market moves week in, week out, then come join me in my private Telegram channel, folks. I run a private group where I call these market moves and give market commentaries week in, week out to my folks in-house. Okay, for the fact if we are able to get to say 2,000 watch 2,000 views on this particular video this month, then I will opt in for a 30 days market commentary where I will show you how to read price action, how to derive directional bias on a daily basis for 30 days. So do make sure you share this video and let's get to 2,000 views this month. Okay, so if I'm able to do that, then I will go on that adventure with you just to show you that these things are not random and these things can be repeated over and over and over and over again. Okay, so this is the result of that. Ever since I called that price action move, look at where we are currently in price, and of course in my private Telegram channel, we know where this price is supposed to go to next. Okay, based on what is on the chart. Okay, so that being said, let's quickly go to the chart of US oil and discuss a little bit of IPDA Dealing Range, and let's look at what we're gonna do on that here. Okay, here is the chart of crude oil. Now, if the previous two videos are not very clear, do make sure to let me know in the comment section. Then I will upload a different shot on YouTube just on those two videos, so you can have a proper understanding of price delivery theory, because it is very important you understand that. As simple as it is, if you understand that, then you are way ahead 90% of traders. Okay, so here I'm going to be doing a detailed explanation on how we blend macro fundamentals with the technical chart. So here is the chart of crude oil, and the current dealing range. When you get to the chart, the first thing you actually want to do is determine the macro range that we are in price. Now, if you look at this chart, you draw a fib from this low here to this high. We came back into deep discount below 50%. Let me just draw that fib and show you. Okay, from that low to that high. Okay, from that low to that high, price came back into deep. Okay, so price came into deep discount, a level where we can actually engage longs to the upside. Okay, so if that is the case, now considering that dealing range, now if you go back into time and count 20 days, 40 days, and 60 days, this is how we actually do it objectively. Okay, so we're analyzing price action in a specific range, just like the algorithm will always refer back to. Okay, it will always refer back to the last 20 days, the last 40 days, and the last 60 days. Okay, so in the last 20 days, what we want to do is that we want to identify the most significant swing highs and swing lows, and that is what I've actually done here. I identified the most significant swing low and the most significant swing high in that range. And what can you notice here is that we haven't changed the structure. What is the structure here? The structure is bearish. Okay, even though the macro fundamentals is suggesting bullishness, the structure right here is still bearish, right? If you look at the last 20 days range, we sold aggressively and we are now inside that range of price action. Okay, so we are now inside that range. In fact, I anticipate a break of structure. So this is how I do anticipate a break of structure before they actually happen. Okay, so in the last 40 days as well, you identify the most significant swing high, liquidity pools that we have in price action, fair value gaps that we have in price action, and in the last 60 days I've identified actually the most significant liquidity pool right there, and that is if we do have a break of structure, that is the initial draw on liquidity. Draw on liquidity. Draw on liquidity. Okay, so upon a break of structure, then I can anticipate that we are definitely going to draw to that level, just using what? Interbank price delivery algorithm range, dealing range, right? Okay, so this is how to look at it, right? Okay, so it's as simple as this. You know, you can do this on any chart. You know, plot out a chart, measure price action in the last 20 days, in the last 40 days, in the last 60 days, and identify the most significant swing highs and lows, what price is actually doing in that range. Mark out your premium and your discount in that range. Mark out your PV arrays, your order blocks, your breakers, your fair value gaps, and liquidity point, as I've done on this one. Okay, so here's how to bridge the gap between macro fundamentals and the technicals. Now, on the technicals there, I said we aren't really bullish. Of course, I can be more aggressive and just when price took out this liquidity pool, right, this sell stops present here, price did return into this other block right here. Can you see that the last down close candle before this upward push, price came into it and price is just trading higher? Okay, but to be more conservative and be on the safer side, I will just wait for a proper break above this swing high. Okay, this short term high present here. Then I'll wait for a retracement into discount. You know, I'll draw my fib from this low to the last swing high it will create, then I'll wait for price to return into discount and start engaging to the upside until we get to this draw on liquidity. Yeah, that's draw on liquidity. Okay. Okay, until we get to that draw on liquidity right there. Okay, so I hope you do find this insightful, guys. You see how I blend macro fundamentals with technicals, and it's very simple, guys. I did not stay on this chart for hours trying to look at this and that. It was a simple rule. Okay, I determined the range we are in price action, noted my swingers and swing lows, and that's it. Boom, it just clicked straightforward. I know what I'm expecting, I know what I want to see, and if that plays out, then I engage price action. Okay, cheers.